Welcome back to the channel, everyone, and before we dive into today's massive financial showdown, please do me a huge favor and hit that like button, smash subscribe, and turn on those notification bells so you never miss a beat, because today we are tackling the ultimate investment debate, and it is so good to have you here with us. Imagine for a second that you just inherited or earned a cool $1 million cash sitting right there on your kitchen table, and you have two choices. You can either dump it all into the stock market or pour it into real estate. But the burning question that keeps every investor awake at night is simply which one will actually make you richer and which one grows faster. This isn't just about numbers on a spreadsheet. It represents two completely different lifestyles and philosophies about wealth. And to understand the truth, we have to look past the surface. Because if you choose the stock market, specifically an S&P 500 index fund, you are choosing the path of the silent accumulator, where you take that $1 million, buy a diversified portfolio of the top 500 companies in the USA, and essentially go to sleep. Historically, the market returns about 10% annually on average before inflation, meaning your money is working for you while you are at the beach, playing golf, or literally sleeping. And the magic here is compound interest, because in year one, you make $100,000, but in year two, you make money on that new total, and over 20 or 30 years, that initial million can balloon into 10 or 15 million without you ever lifting a finger to fix a toilet or chase a tenant. However, the story gets much more complicated and interesting when we look at real estate, because this is the path of the empire builder. And while stocks offer passivity, real estate offers a superpower called leverage. If you have $1 million in stocks, you control $1 million in assets. But with real estate, that $1 million can be used as a 25% down payment to control $4 million worth of property, meaning if the property value goes up by just 5%, you aren't making 5% on your million, you are making 5% on the full $4 million, which is a massive return on your actual cash invested, often referred to as cash-on-cash return. Furthermore, real estate provides a unique quadruple threat of wealth generation. You get appreciation as the home value rises, you get cash flow from tenants paying off your mortgage while putting extra money in your pocket every month, you get the loan paydown which increases your equity automatically, and perhaps most importantly, you get incredible tax benefits like depreciation that can sometimes zero out your income tax bill, something the stock market simply cannot compete with. But we have to be honest about the downsides, because while the stock market is highly liquid, meaning you can sell your shares and have cash in your hand within seconds on your phone, real estate is illiquid and requires significant time and effort to manage unless you hire a property manager, which cuts into your profits. Think of it this way. When the stock market crashes by 20%, you see your account balance drop in real time, which can be emotionally devastating and lead to panic selling. But when real estate dips, you don't see a ticker symbol flashing red on your front door, so you are more likely to hold on to the asset and ride out the storm, making real estate psychologically easier for many investors to hold long term. Let's look at a concrete example. If you bought a generic index fund in 2000 versus buying a portfolio of rental properties, the stock investor likely dealt with the dot-com crash and the 2008 financial crisis with high volatility, whereas the real estate investor, despite the housing bubble bursting, likely maintained cash flow from rents because people always need a place to live even during a recession. So who actually wins this race? If you want zero stress, high liquidity, and historical compounding without any work, the stock market is the clear winner for the passive investor. However, if you are willing to treat your investments like a business, use the bank's money to amplify your returns through leverage, and take advantage of tax loopholes, real estate is historically the faster vehicle to massive wealth, but it comes at the cost of your time and energy. Ultimately, the faster growth depends entirely on whether you are using leverage in real estate or just buying cash, because leveraged real estate usually outperforms stocks, while unleveraged real estate often lags behind. The best strategy for many millionaires is actually a hybrid approach, using the stability of real estate to preserve wealth and the growth of stocks to build it. But you have to decide which kind of investor you are today. Thank you so much for watching, and if you found value in this comparison, please smash that like button, drop a comment below letting me know if you are team stocks or team real estate, and don't forget to subscribe for more financial deep dives. I'll see you in the next video.